Imagine a company receives $12,000 from a customer today, but is not allowed to record it as revenue yet. Today, we will explain exactly why this happens and how to calculate and record deferred revenue the right way. Welcome to Accounting with Yana. Let us start with the definition. Deferred revenue is cash that a company has received from a customer but hasn't yet earned. In other words, the company still owes the customer a product or service. Here's a simple analogy. Suppose you pay $120 for a one-year magazine subscription in January. The publisher now holds your $120. But have they earned it yet? No, they must still deliver 12 issues, one each month. They will earn $10 per month as each issue is delivered. That unearned $120 sitting in their account, that is deferred revenue. Please note, under accrual accounting, which is required by GAAP, a company may only recognize revenue when it is earned. This rule is defined in ASC 606, the Revenue Recognition Standard. Cash received before the service is delivered is a liability, not income. I have many videos about revenue recognition. I am posting the link to the playlist right here and in the description below. This is a very important distinction that many students miss. Deferred revenue is classified as a liability on the balance sheet, not as revenue on the income statement. The reason is simple. The company owes the customer a product or service. Until that obligation is fulfilled, the money doesn't belong in revenue. If the company fails to deliver, it must return the cash. That is why it is a liability. Please note, if the service will be fully delivered within 12 months, the deferred revenue is classified as a current liability. If it extends beyond 12 months, the long-term portion is classified as non-current liability. To learn more about short and long-term liabilities, make sure to watch my videos. I am posting the link right here and in the description below. Now, let us walk through a full example together. On October 1st, a software company signs a contract with a new customer. The customer pays $12,000 upfront for a 12-month software license. The contract begins October 1st and ends September 30th of the following year. The company's fiscal year ends on December 31st. Our question is, how much is deferred revenue on December 31st? Let us solve this together step by step. Step 1. Calculate the monthly revenue rate. We take the total contract value, $12,000, and divide it by 12 months. 12,000 divided by 12 equals 1,000 per month. Step 2. Determine how many months have been earned by December 31st. The contract began on October 1st. By December 31st, 3 months have passed: October, November, and December. So, the company has earned revenue for 3 months. Step 3. Calculate the earned revenue. We multiply $1,000 by 3 months. $1,000 times 3 equals $3,000 in earned revenue. Step 4. Calculate the deferred revenue balance at December 31st. We subtract the earned revenue from the total cash received. $12,000 minus $3,000 equals $9,000. The deferred revenue balance at December 31st is $9,000. Excellent! We have all 3 numbers we need. Now, let us record these transactions in the books. Step 5. Record the receipt of cash on October 1st. Debit or increase cash $12,000. Credit or increase deferred revenue $12,000. This entry records the cash received and creates the liability on the balance sheet. If you are not familiar with the rules of debit and credit or need a refresher, watch my video. I am posting the link here and in the description below. Step 6. Record the adjusting entry at December 31st, the end of the accounting period. Debit or decrease deferred revenue $3,000. Credit or increase revenue $3,000. Please note, with this entry, we are moving money out of the liability account and into earned revenue. This is how deferred revenue becomes recognized revenue, as the company fulfills its obligation month by month. Voila! Your journal entries are complete. If you're finding this video helpful, please make sure to subscribe, hit the like button, and ring the notification bell so you are notified when we release more videos like this. Before we finish, let us go over 2 common mistakes. Mistake number 1. Recording cash received as revenue. When a company receives cash upfront for a service not yet delivered, it must record that cash as deferred revenue, not as earned revenue. Recording it as revenue too early overstates income. This is a violation of the matching principle and ASC 606. Mistake number 2. Forgetting the adjusting entry. At the end of each accounting period, the company must transfer the earned portion from deferred revenue into revenue. If this adjusting entry is missed, revenue is understated and deferred revenue is overstated. Both the income statement and balance sheet will be incorrect. Please make sure to review your deferred revenue accounts at the end of each reporting period. Let us review what we covered today. We learned that deferred revenue is cash received before a product or service is delivered. It is classified as a liability, not income. We calculated how much revenue is earned and how much remains deferred using a 4-step process. And we recorded both journal entries correctly. I hope you found this video helpful. If you have any questions, feel free to leave them in the comments. Thank you all so much for watching, and I hope to see you all again in the next video.